Right, 1400 hours. Welcome to this edition of Market Views, the Tuesday edition. Very much appreciate you giving us your time this afternoon. We promise to make it worthwhile. My name is Sifiso Malo. Happy to be your host this afternoon. Today's agenda, we want to focus on the Consumer Price Index August report, which records the inflation levels, which has recorded a 2.6% cooling. That is its record lowest in 12 months, and it records that this August. We're going to examine whether this stability in prices translates to relief for households, as well as, or is it masking pressure points elsewhere in our economy? That conversation with our economist, Sanilas Bia, who I hear through the grapevine that is already walking our hallways. So be ready for that really candid and very interesting conversation as we make sense of these numbers and what they mean for myself as well as yourself. Let's start with our business news first, though. Right. In our first story today, we are going to profile this story from the scholarships, which is the Minister for Labour and Social Security, Honourable Philap Telezi, who is urging anyone who paid for a scholarship to report to the ministry with cases to be referred to police and the ACC, that is the Anti-Corruption Commission. Economists have warned that the sale of scholarships is not just illegal, but it is economic sabotage. When bright, deserving students are shut out by corruption, the nation loses the very talent that is needed to drive innovation as well as growth.
The Minister for Labour and Social Security, Honourable Philap Telezi, reiterated that scholarships are not for sale. He says these scholarships are strictly awarded to deserving individuals who have been accepted into local institutions of higher learning based on clear, merit-based point system. Honourable Philap Telezi says not a single cent is required to access scholarship, dismissing claims that payment guarantees placement.
Government scholarships are not for sale. Position ilitiko nje lesithi asiyibeke ema-study loans anikwa eMaswati labonakala ukuthi emakolishi emukelekile ne-performance yawo kushoda kwetimali ukuthi singakhona kubanika bonke. Kunama-point lakalekile kubuka lokuthi labende kanje kuyabalungela ukuthi bangasidakala kuma-study loans. Kude nasenti lokubhadalako la itiko. Kude ama-scholarships lathengiswako. Tikhona tona tinkulumo lesihle sitithola njengoba kuvela nasemaphalamende sike sayikhulumise emahlandla, but those remain allegations. Leli tiko lebatsinzeka kokumbe lebebasabonakala basoleka batsinzeka kuleto tinkulumo bapotwa emaphoyiseni lasento umsebenzi wawo. For now kusete na inye conviction lekhona lekhomba ukuthi ukhona lo wathengisa scholarship. Kumbe iyawuba indzaba lephatheka komhla sekukhona lo sagwetshiwe ngobufakazi lokuphatheka ukuthi ukhona lo thengisile. Nathi singathokota nakangaba khona lokugwetshwa kungeke ukuthi ukwendile nakakwendile vele ajeze ngoba kusiko lesithunywa kona. Kuqiniseka nje kuqinisa sive ekutheni cha ama-scholarships awathengiswa. Nakungaba khona nje lo ngathi ubhadalisiwe scholarship zingathokota avele tiko. Sitawubambisana nawo amaphoyisa nabo anti-corruption dilanzelele tindzaba tufike emaphethelweni.
The Honourable Minister confirmed that the ministry continues to receive reports from members of the public, even Parliament, claiming they were asked to pay for scholarships. He says without solid evidence, these cases remain allegations. He noted that individuals suspected of involvement have been reported to the police before and they are being investigated, but so far no convictions have been made. Reporting, Nelson Dlangamandla, Vuminkosi Nzinisa, Mbabane.
E-Wade, NOM-Board and the Deputy Prime Minister's Office have signed a memorandum of understanding to form a transformative partnership that is under the Smallholder Agricultural Productivity Enhancement as well as Marketing Project. This groundbreaking collaboration places smallholder farmers, particularly those in rural areas, at the center, with a strong emphasis on empowering the youth.
The future of agriculture lies in shared resources, coordinated action, and collective accountability. By joining forces with NOM-Board, the Minister of Agriculture, the Deputy Prime Minister's Office, and our valued partners, we are creating a holistic ecosystem that supports farmers from production to marketing. This partnership reflects the best of collaborative governance, where every institution contributes its unique strength to common vision.
The Undersecretary at the Deputy Prime Minister's Office, Makosi Simelane, who was representing the Principal Secretary, Siboniso Ngambule, says the agreement promotes financial inclusion.
Our mandate is to mainstream gender, children, persons with disabilities in all our activities. And clearly, we are also excited to hear the CEO making specific mention of leaving no one behind. We continue to have conversations for financial inclusion so that no one is left behind in implementing this particular groundbreaking project.
NOM-Board's Chief Executive Officer, Bhekizwe Maziya, highlights their part in the agreement.
Some of the responsibilities and obligations we will be facilitating in this relationship includes, but not limited to, the following: facilitating structured buyer-seller agreements, supporting the identification and engagement of local, regional, and export markets, identifying opportunities for investment or refurbishment of marketing infrastructure where required, providing capacity building on quality and safety standards, post-harvest handling and grading for market compliance.
According to E-Wade, the Smallholder Agricultural Productivity Enhancement and Marketing Project seeks to establish a resilient, market-driven and sustainable agricultural system. The project is supported with over 851,000 emalangeni from key partners, including the International Fund for Agricultural Development and the Green Climate Fund. Reporting, Nelson Dlangamandla, Vuminkosi Nzinisa, Mbabane.
That's our business news. We have Sunny Lesbia in studio after the break, drilling into the Consumer Price Index report, August 2025. Stay with us.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.za.
Welcome back. It's 9 minutes after 2. Thank you for staying with us. Let's discuss now the Consumer Price Index report, August 2025, with Sunny Lesbia, who's here in studio with us. Thank you so much for your time, Mr. Sbia. It's an interesting report, and you look at what it highlights here and what it records. But perhaps, as I premise this conversation, the rate for last year's month stood at 2.6%, which is the lowest in years, marking a 0.2 percentage point drop from July, 2.8%, and a sharp fall of 1.5 points from August 2024, which was 4.1%. Good inflation, which came in at 2.8%. Services inflation registered 2.4%, both reflecting a stable pricing environment, which is according to the Consumer Price Index report, which we discuss now with Sanele Sibiya. Thank you so much for your time, Mr. Sibiya. I hope you're doing well.
Thank you, Mr. Nxumalo. Good afternoon.
Good afternoon. It's quite hot outside.
Yeah, it is.
Temperatures are very high. Look, I suppose the big picture here is looking at the 2.6% inflation rate.
Yeah.
And they are saying that it's the lowest in years, not a year, years. What is the real story here? It could be the evidence of resilience in our economy, but it could also be more of a reflection of external factors that are beyond our control. What is it?
Thank you, Mr. Nxumalo. Man, at least something is cooling, in as much as the temperatures are rising now, but inflation is actually cooling. So what we're looking into right now is when you look at the global landscape, if you look at the report and you dig deeper, you'll realize that transport is actually one of those major contributing factors to this cooling that we're seeing in inflation. So if you look at where we were in terms of the dollar-lilangeni exchange rate last year at about this time, you and I were always checking these numbers. We're around 18 something, and now we've come down to that 17 something region in terms of the lilangeni dollar exchange rate, and now that bodes well for our fuel. And then also in terms of the price of Brent crude oil overall, if you remember where we were last year this time around, we were far from that 70 region, and everyone was praying that we come back to that. We were around 80 something, $80 something per barrel, and then right now we're at 65, and it seems we've stabilized around there, and that seems to be the new equilibrium. So those are global conditions are actually going to contribute to the numbers that we are seeing in terms of that inflation. This disinflation spiral being led largely by transport, and we're also seeing those alcohol and tobacco levels also coming into play, and we're seeing that disinflation in that spectrum as well. So remember, we're coming from COVID. There's been a bit of that cooling after the COVID period in terms of quite a lot of our activity of our commodities were under lockdown, and then we were seeing all of those issues come into play, Mr. Nxumalo. So we could say that, yes, external factors are playing quite a huge role to what we're seeing. But it is also indicative of either some strengths in the domestic economy or some weaknesses in the domestic economy. So we'll have to wait to see what the GDP figures show, because, for example, if you look at what is happening with your hotels and accommodation, and then you look at with what is going to happen, more especially on the restaurant space, when you look and dig deep into the numbers, you'll see there's a bit of weakness there. It could be an issue of demand weakening, or it could be an issue of rebalancing of the demands by households. So it just a lot remains to be seen.
Interesting indeed. The inflation by category. I see you mentioned restaurants and hotels. Those numbers are reflected there. Food and beverages, I suppose, restaurants fall under that particular category. But if we really now bring it home for our viewer at home, especially one in Hlangano, one in Manzini, one in the whole region, pretty much everyone, what does this reflect about their day-to-day living costs? Is it a relief that is meaningful entirely, or are certain essentials still out of reach?
So that's quite an interesting story, because when you look at the overall number, you would think things are relatively okay, but that overall number does mask a bit of other dynamics within them. For example, when you look at the 2.6% month-on-month and then that decline, that's largely being pulled by transport and also by the food component of things. But if you look at other utilities, we know that utilities are what we call controlled substances and controlled goods, which you can't really run away from. And then when you dig deeper into the report, you realize that health, for example, showed a 3.5% uptick within this very same number. So what we're seeing here is overall things seem to be cooling down, but the question then becomes what happens to those daily essentials that we cannot afford to do without. What is happening to those? What is happening to the price of around education? What is happening to the price around health? What is happening to insurance as well? Because when you look into the numbers, you realize that insurance is also on an uptick in terms of those services. So it does mask that bigger picture, and in terms of whether households are feeling the relief or we still are, or we're seeing this happening because households are still just trying to ensure they do and engage on those bare necessary transactions.
Yeah, the utility story is an interesting one indeed, and those dynamics that are pretty much covert within this whole story make the whole thing very interesting. That is why we then bring you guys in studio, because you help us really understand those nuances. But the winners and losers of it all, there's interesting divergences that we see here, and you did highlight what we saw there with tobacco and alcohol prices rising sharply. It's quite a sharp rise there. But at the very same time, restaurants and hotels cooled quite dramatically, if you will. What explains such divergences, and what do they tell us about where demand is strongest and where it's weakest?
So what we need to look into here is we just fresh off a farming season, and we do expect food inflation to somehow slow down during this period because we've just harvested. And when you look in terms of those accommodations, those the accommodation sector, again, we had the bushfire, and that came and went, and then we should see this cooling off, and we should then expect to see a bit of a rebound come the September report when Umhlanga effect comes into play there. So that's how you need to look at it overall, and then you take away these other, those noise factors, and then you focus on the core issues. So what we're looking into here right now is we do expect that core inflation is going to remain relatively on a certainly relatively higher compared to the headline, largely because of those issues that we've spoken about in terms of your utilities. Those ones are what households need to spend on a daily basis, even though they may not be inflating, but what is now happening is the price points and the price pressures remain very high, which is why we could be seeing that divergence from households in terms of that demand, in restaurants and recreational activities, because, households are spending their income on the bare necessities.
I want us to look at, obviously, the structural height of it all and the insight therein, because housing and utilities, they continue to be the single largest contributor to inflation. And, it could signal a lot of things about pressures in our cost of living structure, for lack of a better term. Are we doing enough to manage them sustainably?
Sustainably.
Yeah.
I mean, that's one of the things that came into mind when I looked into the report, and I was thinking to myself, let's wait for the GDP report to really tell us what is happening.
Yeah.
Are we seeing these numbers happening on the background of a stable growth, or it is an issue of weakening demand? Because when you dig into those housing and rental utility and rents there, you realize that it seems that rental prices seem to be slowing down. And that could be another indicator to demand, Mr. Nxumalo. That's why we are a bit, taking these with a grain of salt, because we still need to get more clarity, from the GDP figures in terms of whether it's coming off of a strong base, whether it's a stability, or it's a sign of a weakening demand.
That caveat is very important there. Let's look with a forward-looking approach to things now. And I appreciate everything that you've said. At 2.6%, we are comfortably below 3 to 6% range, often targeted in the region, right? That is often the target. Should we view this as a breathing space for households and policymakers, or is there a risk of deflationary pressures that are creeping in?
Again, for me, it's quite paradoxical. And what we need to look into is what are the sources? Is it coming off of a strong base? And what impact is this going to have on our fiscal space and overall, monetary and fiscal policy? So on the fiscal side, Nxumalo, this would seem to be a good thing, because you know that, quite a number of our negotiated pays and settlements are actually based off of the inflation data that comes in. So next year, we should then probably expect, another right around 3% increases in salaries and quite a number of those things. So that's a given. It's going to be good for the fiscal space. But on the reverse, what you then have is a situation where Eswatini is a consumer-led economy. So if the figures we are seeing are showing fatigue on the side of the consumer, then it's kind of a a double-edged sword for the fiscal space, because if consumers are not out there buying by much, then business as well is not going to have the very same volume that they would have had, and same effect is going to happen onto the tax revenues. So it's kind of a double-edged sword. That's why I still say let's wait for the quarterly GDP data to come through and give us a bit of an indication whether we're seeing growth in those areas where we would expect growth to come from. For example, in your retail, your wholesaling space, basically that consumer space, including, the restaurants and the entertainment space.
Does that mean it might be premature to then, as policymakers, as, of course, monetary policymakers as well, to sort of understand what this inflationary environment demand, because it could either tell them whether this is a moment to consolidate, whether this is a moment to stimulate, or a moment to hold the line? Is it too premature to get that sort of
It's
idea?
not premature, but the governor has a dilemma to deal with right now.
What is that?
You know that our monetary policy has to be in synchronity with that of South Africa.
Yes.
But right now I think we're around 0.25 basis points lower than South Africa. So what these numbers dictate is for an interest rate cut. But then the question then remains, can we afford to diverge even further from South Africa? Because when you look at the numbers in South Africa, they're around 3.5%. They are still within the band. So for us, what I would do if I were the governor, I would cut the interest rate to get us back to within the band, at least the 3 to 6%, because that is the band where we need to be, where we're quite comfortable that demand is going to allow for commerce and business to also continue to thrive. Because what this means is, as the price continues to decelerate, price growth continues to decelerate, it also means the prices and the margins for commerce are remaining relatively stable, at the same level, so it doesn't give that incentive to businesses to come into production.
What a diplomatic way of you to tell the governor to cut the interest rates back to 3 to 6%. But what's at the cost there if he does that immediately?
So right now, I think what he has to balance mostly is CMA monetary policy convergence, because we can't afford to be at a rate that is far away from that of South Africa, because then there's going to be that capital flight. For example, right now, with the current interest rate differential between South Africa and Eswatini, that means your interest earns more money in South Africa than it does in Eswatini. Though then when you look at it in real terms, you'll realize that in Eswatini we still get that real return in investment. But what that then depends on where you're going to consume the money, but we know that money flows freely within the CMA. You could go and invest in South Africa where there's a bit of a high inflation, get that high interest rate, and then you come back, spend the money in Eswatini. So in real terms, you still would have grown your money, but what the governor has to contend with is that capital flight. So we can't afford too much of that differential, while at the same time, we need to stimulate the economy. Right now, what this says is we need stimulus in the economy to get back to at least 3%.
In our local economy, that differential sitting at 0.2% right now. No, it's not very marginal. It's not very big, right? It's rather marginal.
In terms of money and capital,
it's a lot.
Quite a lot.
Interesting conversation here with Sandelas. We are discussing the Consumer Price Index Report 2025 for the month of August. We have him in studio for our market analysis just now.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.sz.
Sana Lesbia is still in studio for our market analysis now, and we have a little under 5 minutes. So you take center stage. Just take us through the numbers.
All right, thank you, Mr. Ngumalo. So what we're looking into, Wall Street closed on a very high note yesterday. It's purely because we're waiting to see. Tomorrow, we're expecting that 0.25% basis point cut in interest rates in the U.S. with the Nasdaq there, really just pulling ahead, largely because we're seeing, positive news around the NVIDIA story, the TikTok story, in terms of Trump being able to ensure that they don't get to sell and TikTok continues to operate. So now that speaks to more of a stable environment for those AI stocks and those tech stocks within the U.S. economy. And then also we are waiting to see what's going to come out of that trip to the UK by President Trump today. So we will be waiting to see those, but main highlights: the interest rate cuts tomorrow and the closing up of those China talks on Friday. That's what markets are reacting to. You go to Europe. Europe is a bit sluggish right now, largely due to the fact that, the dollar is weakening, relatively weakening, because it is expected that we are going to see that interest rate cut. So what that then does now to investors is it makes those euro-based and those, pound-based equities a bit more expensive compared to those that are priced in the US dollar. Yeah. So we're seeing that divergence there. But we are expecting President Trump to announce, a very big nuclear deal today with the UK, and we've seen the likes of Google promising, big investments into the European market. So we're waiting to see how that is going to stabilize as we go into tomorrow. And again, there is a bit of policy divergence within the US and the UK and the overall Eurozone, in the fact that we're expecting the US to cut interest rates, and we're expecting the Eurozone, including the UK, to hold steady right now, because inflation in those sides of the globe seems to be going up a bit. Moving along into Asia, we've seen the Nikkei in Japan there, closing at that all-time high, records we've not seen. It did hit the 45,000 mark yesterday in today's trade, and then again closed just a few points shy of that 45,000 mark on the background of that US Fed rate cuts. And in China, we've seen the government in mainland China, coming up with a stimulus to actually blow, facilitate service consumption. In South Africa, we're seeing the JSE staying around that 105, gaining some 400 points, purely because, we're seeing the metals, being stronger today and being supported by that weaker dollar. So we're seeing gold really pulling ahead and pulling the overall JSE index upwards. And, the inflation figures that are coming out signaling that we are due for yet another interest rate cut. In Eswatini, we're seeing that there are no movements in the domestic stock markets. And in terms of our commodities, we see that, gold is holding steady there at a new all-time high of 3,734 US dollars per ounce. And now that's largely being driven by the interest rate cut expectation, and we're seeing that in the weakening dollar. So we're seeing those forex traders moving therefore their holdings from currency into metal-based as the dollar continues to weaken. Brent crude oil also continues to climb down. I mean, we've seen Marco Rubio already landing in Doha. So now that shows that we are going to see a bit of a stabilization on those geopolitical tensions between Israel and Qatar. So now the markets have priced in a less volatile oil market going forward, as the region is not going to be plunged into broader conflict. And then overall, we're seeing the Lilangeni stronger on a day-to-day basis, but on the intraday trade, it does show some signs of weakening a bit. And I mean, it did get to 17.35 earlier on in today's trade against the dollar. And then when we quoted the numbers, it shows a sign of a deepening. But the metals are holding steady and actually propping up the Lilangeni. So we're seeing a bit of a stronger performance across, all currencies, just weakening across when you compare with the Japanese yen, because we do expect the Japanese Bank of Japan to actually cut interest rates, and that's going to prop up the yen. Thank you, Mr. Numa.
That marks the end of the show. Thank you for staying with us. This has been Market View, the Tuesday edition. Sandals Bia, thank you for your insights as well, and thank you to you for staying with us here on Market View. Enjoy the rest of your day. Bye-bye.